We've got Dhaval Dalal, who's Senior Vice President and Head for Fixed Income at DSP BlackRock Investment Managers. He joins us on the show from Mumbai. Dhaval, to begin with, big positive surprise for all of you in the markets last Friday. Today, when you look ahead to the Thursday policy, what are you expecting from the RBI? Do you expect that they will possibly move ahead now with interest rates?
In fact, the 75 basis point CRR cut was by and large anticipated by the market participants, given the kind of liquidity deficit that the market was anticipating. And it was quite obvious that if the RBI would have waited for 15th of March to announce a CRR cut, it would have probably been effective 23rd of March, which would have been quite late, given the advance tax related outflow would have put further strains on the banking system. But at this point of time, with the CRR cut already in place, market participants are focusing on what could happen on 15th of March, and we believe that there is an outside chance of a 25 basis point cut in the benchmark repo and reverse repo rate.
So, Dhaval, in light of this, what's the range that you're foreseeing for the yield on the 10-year bond?
I think after the credit policy, the market will focus on the major issue, which will be the budget. And the market is likely to focus on what kind of gross borrowing number is likely to be announced. I think the consensus is between 5,30,000 crore to 5,40,000 crore. And also the tone of the budget, whether it's going to be fiscally consolidating or it's likely to remain slightly more pro-poor. And keeping all that factor in mind, I think market participants will decide the course of the range for the bond yields. We personally believe that with the series of CRR cut and some of the rate cuts that we are likely to see in calendar year of 2012, I think the benchmark 10-year should trade between 8 to 8.10 in the medium term.
Right, Dhaval, just bringing it back to the liquidity picture, we don't yet have the RBI release on what the LAF results for today have been. But do you expect that, despite this money coming in, on account of the advance tax outflows, we will still go back to levels of 140, 150,000 negative in the banking system, maybe by end of this week?
I think we may not see those kind of peaks because the kind of peaks that we saw was because of some amount of product maintenance and because of some holidays which were there last week. But having said that, we are not sure what kind of advance tax outflow will be there. I think the number is between 65 to 70,000 crore, but I think 48,000 crore should be sufficient to ensure that we do not reach to those highs again.
Sure. Now, Dhaval, over the last few days, people like you in the mutual fund business have been having a field day because short-term interest rates have spiked. But are you seeing it cool today, and do you expect it will stay at these levels, or do you see them climbing back up? Because we know that some banks were accessing the 3-month CD market just last Thursday at rates of 11.25, 11.5%.
I think we expect the 3-month rates to remain in the range between 11 to 11.30, or it may even go slightly higher depending on which bank is likely to borrow in second half of March. Please remember that there are about 1,40,000 crore worth of CDs maturing in month of March alone, and I think some of the banks are likely to roll over. Some amount of rollover had been witnessed in month of February alone, but given the kind of pressure and the tightness in the systemic liquidity that we have seen has resulted in more and more banks coming to borrow and to ensure that they don't get stuck up in case if they have rollover coming in the second half of March. But at the same time, it is important to note that many banks are likely to come and borrow in next couple of days, and I think if their borrowing is coupled with advance tax related outflow, then you could see some amount of spike in the yield for 3 months. But right now I think many mutual funds are buying, looking at the attractiveness of the 3-month bank CD yields, and I think if the demand is matched by the supply, and if the supply is not more, then I think we are pretty much at the peak of the 3-month rates in our opinion.